Since we're on the subject of geography and a sense of place, a theme in both Jen and Andy's presentations, now let's turn to Assistant Professor Stefanie Ramirez from the Department of Business, whose work explores the effects of proximity to state borders on alternative financial services, including the payroll lending industry. Stefanie's work has direct implications for state policymakers and financial regulators, so she makes a concerted effort to communicate her findings of her studies not only to her fellow economists, but to broader audiences. Please welcome Stefanie.
Thank you, everybody, for being here this afternoon. And today I am going to talk about some geographic spillovers as a result of payday lending policy, but also discuss some market spillovers as a result of policy as well. And the main question that motivates my research is policy effective in the way that it is written and implemented? And if not, what are some of the spillovers that might occur as a result of some unintended policy consequences? The motivation for my research in the payday lending industry started when I was a research assistant at the Federal Reserve Board. My first assignment was actually me collecting data both on payday lenders themselves as well as state-level policy data pertaining to the industry. And I had extensive work surrounding the financial crisis in 2008, cementing the relationship between policy and markets. And additionally, my family has been a huge motivator in my policy as well. All members of my family have some experience professionally in the financial services industry. In particular, my mother, who had a 30-year career in the mortgage industry, and she was a great resource for practical characteristics to look at in the industry and during the financial crisis as well. If we think about financial services, they can be categorized into two main categories: traditional financial services such as bank loans and credit cards, and alternative financial services such as pawn shop, check cashing, shorter term loans, smaller denomination loans that target a specific consumer segment, those that are demanding financial services. Specific to the payday lending industry, this is a short-term loan designed to be no longer than 30 days in length. The average loan size is small in amount, no more than $300 to $500 in size, and borrowers that do typically borrow payday loans are using this to supplement shortfalls in income, whether they are emergency expenses or reoccurring shortfalls. At the state level, this is who primarily regulates the payday lending industry. At the federal level, the payday lending industry is currently monitored by the CFPB. They are in a rulemaking phase, now establishing policy with respect to the practices within the payday lending industry. At the state level, policy can be categorized into one of three categories. Number one being restrictive or prohibited, where the industry is outlawed from operating. Number two being permissive, where the industry is allowed to practice according to accepted market practices. Or hybrid, where the industry is allowed to exist, but those restrictions are a little bit tighter. And we can see from this map that most states do allow payday lending to operate within state borders. However, the exception is the East Coast and New England region, where most of these states do restrict and prohibit payday lending from operating within borders. The first study that I'd like to highlight does look at interstate spillover effects as a result of establishing a prohibitive payday policy. In 2008, Ohio restricted interest rates to 28%, and I identify spillover effects in two particular areas. In potential substitute industries identified as pawn shops and precious metals, and are there industries that allow for circumvention, identified as small loan and second mortgage lending industries. If we look at the number of licensed payday loan branches in the state of Ohio between 2006 and 2010, we can see that the number of licensees is dropped practically down to zero after the state moves to prohibit the practice. So in essence, on paper, this policy is effective in prohibiting and limiting the practice. However, when we look at the effect on pawnbrokers, immediately after the state's first policy movement, we can see that the number of licensees almost double within the industry. As consumers move to substitute products, so do firms follow. In the next slide, we're going to look at precious metals dealers, and we can identify that there really is no market response in the number of precious metals licensees surrounding policy movements. Therefore, these industries are not quite as related as one would think. Rather, the number of licensees react more to market signals, that being the price of gold per ounce. Now, when I'm trying to identify spillover effects in potential circumventing allowing industries, if we look at the number of small small loan lenders, immediately after the first policy initiative, we can see the industry almost triple in size with the number of licensees and return to pre-policy size when it was revealed former payday lenders were actually operating as small loan lenders. Finally, looking at the trend in second mortgage lenders, we can see the effects of the financial crisis in the significant contraction in this industry. But again, after the first policy movement, the second mortgage lending industry exhibits almost a recovery in direct contradiction to market signals, that being the price. And so because of this contradiction, additional questions need to be asked. If we explore further where this expansion is coming from in the three industries that did exhibit spillover effects, in the small loan lending industry and the second mortgage lending industry, primarily and majority, the licensees were former payday lenders that had moved over operations into these particular industries. In looking at geographic spillovers, myself and my co-author, Caitlin Harger, we look at how do border concentrations of these branches differ when adjacent to other policy environments. Blue states represent states where we have data for, green states enable the practice, red states restrict, and yellow states there is no established policy. And we're interested in two particular outcomes. First, the one being the number of new branches, and so expansion in this industry, and states that border states that prohibit payday lending have almost 69% more new branches in a particular county, so showing that these lenders are specifically targeting these counties for expansion and markets that may cross state borders. Additionally, with the size of the industry in those counties, states that are adjacent to prohibitive states have 33% more operating branches, and states adjacent to also enabling states have 15% more enabling branches, showing there are spillover effects in geographic areas, especially when markets themselves spill over geographic areas. Again, returning to the central question that motivates my research, is policy effective as it was intended? There are potential unintended consequences of policies being established, and so what I hope my policy does is inform those that are in charge of writing these rules as to what those unintended consequences are. And ultimately, what are the effects on consumer welfare? This is a product that is being utilized. These are substitutes that are being utilized as well. Are we shifting a problem from one industry or one state to another, or are we actually solving a liquidity crisis or liquidity demand? Thank you very much.
Thank you, Stephanie. It's really exciting to know that policymakers are paying attention to your research.